So hello and a very warm welcome to the latest market update webinar. Thanks for taking the time to join us. I'm your host, Carl Turner, and I'm part of the W1 Investment Group. Myself and my colleagues, we provide specialist financial advice and solutions to expatriates around the world. I'm delighted to welcome our guest, Nathan Sweeney. Nathan's the Chief Investment Officer at Marlborough for their multi-asset funds. Nathan's got over 20 years multi-asset investment experience. He's won various awards and he's very well respected in the industry. So before I pass across to Nathan, just to inform you, after the presentation, we'll have a Q&A session. So you can ask any questions in the Q&A box and we'll try to answer those live. So Nathan, welcome and over to you.
Good morning, everybody, and thank you, Carl, for the introduction. So the title of today's presentation is Stay Invested, Time the Market or Hold Cash. And what we want to do is investigate the mindset of investors, particularly with the view to understanding what that means for cash, what that means for bonds, and what that means for equities. So what I want to get across today is an engaging and insightful presentation. As mentioned, if you do have questions, pop those in the box and we'll pick them up as we go along. But before I get into any of that, I'll just give you a quick recap of who we are. So Marlborough is a very well-known and established UK asset management company. We're privately owned, and I believe this is a good thing because it means we can take a long-term view without having to be distracted by a company's share price or short-term revenue targets, so quarterly earnings, unlike a listed company. So for me, this ensures that our investment team are focused on managing client portfolios. Now, we're very privileged that W1 has chosen us as their preferred investment partner. And we're really happy to work with W1 because they're a very professional and credible financial planning firm. So Marlborough, we're the investment experts. So ultimately, it's our role to manage portfolios in a responsible way. And that includes ensuring that we've got diversified portfolios, and we want to populate those portfolios with well-researched and credible investments. I'll just give you a quick intro to the team. So this is the team running your portfolios. And so I'm very proud to have an experienced team with over 125 years of experience. And this ensures that we can assess those underlying investments on a daily basis. It's probably worth highlighting that Sarah and Scott, who you can see in the slide, they've actually recently been promoted within the team. So they've been promoted from analysts to assistant portfolio managers. And that means that they can assist both myself and Raj, who you can see on the slide also, in managing your portfolios. So back to the main presentation. So what are we going to cover today? The question I considered is investing challenging for investors given the difficult year we experienced last year, which impacted all of us in some way or another? So today I want to provide some insight into some key topics. So firstly, I'm going to provide some insight into behavioral biases that can impact how we think about investing, as I think this is more critical today given our feelings about markets. So the title of this is The Cycle of Investors' Emotions. One of the areas in portfolios which has been, I would say, disappointing this year, we've had a positive return, but it hasn't been stellar, is fixed income or bonds. So I want to address that head on and give you some insight into how we think bonds will play out from here. So the title there is A Change in Direction for Bonds. And then lastly, lots of people may be questioning whether we should stay invested, time the market, or hold cash. So let's try and answer that question. And I'll wrap up by providing some insight into what we expect to happen in markets over the coming months and as we move into 2024. So the cycle of investors' emotions. So this is titled Investigating the Mindset of Today's Investors to provide a view and outlook on those three asset classes, so cash, bonds, and equities. So this is quite a nice slide because really what it does do is it highlights those investor emotions. So I think it's really important that we're aware of our emotional biases because emotions can impact how we think about investing and also our relationship with money. So for me, I was really fascinated when I read this statistic and I saw this chart, and it showed that 90% of our investment decisions are driven by emotions rather than logic and reasoning. So this was according to a survey which was carried out by MoneyWeb in 2022. But I do think that emotions do drive how we think about investing. And there's several reasons for that, because inherently investing involves risk. And as an individual, if you see your hard-earned cash fluctuate in the market, it can evoke a range of emotions. And the range of emotions are captured on this slide. When markets are going up, we're quite optimistic. So sometimes that can lead to excitement if you can see a rapid move in markets, and that can clearly lead to anxiety when markets are going down, or a feeling of hopelessness, particularly last year when markets sell off aggressively. Now, there are more detailed versions of this slide, and interestingly, between hopelessness and relieved, you get skepticism. So I think for a lot of people earlier this year, when markets started to go up, they were skeptical about, can markets continue to go up? But the key point here is that investing is inherently risky, and ultimately that does evoke emotions. Ironically, on this slide is that often we are least worried when you have the most risk, and we are most worried when you should be more optimistic. So it just really shows you how those emotions can work against you, particularly if you're trying to meet a financial goal, because you might make the wrong decision, and an emotional decision, not a logical reasoned decision, at the wrong time. And I'll just add one more thing on this. If I was to ask you about cash, bonds, and equities, and where you think they fit on this slide, you would probably have a different answer for all three. So if I was to ask you about equities, you might be relieved or a bit more optimistic. You might be still skeptical. If I was to ask you about bonds, you might not. You might be feeling a little bit hopeless about the return that they delivered last year and the lack of return this year. If I was to ask you about cash, you might think, actually, I'm a bit more optimistic, or possibly I'm even excited about the probability of the higher interest that I can get on cash. But it even shows you within asset classes, we can have different feelings about how we think about them. So when we look at psychological biases, there are a number of them. So the reason I find that statistic fascinating is because we spend a lot of time as a team trying to avoid the common mistakes of emotional investment decision making. So we want to ensure that we're making rational, evidence-based decisions. So on this slide, you can see a range of those emotions that can drive our investing. So a number of these biases are depicted here. Let's start with herding mentality. So many investors will tend to follow the crowd, buying when others are buying, selling when others are selling. So this can often lead to emotions that are driven by fear and greed, rather than rational investment analysis. So if we think about herding today, I think a lot of people are herding into cash funds. Is that the right or wrong thing to do? So cash funds might look attractive today, but you're not being compensated for inflation because the level of interest is lower than the level of inflation. So therefore, you're still worse off. And the reality is that investing in cash does not enable you to meet your long-term financial goals. So investing actually does that, and I can go on to explain that in more detail in a couple of slides. Overconfidence. So this is something which a lot of people display. And this really comes down to things like timing the market. So I have a belief that I can get these calls right, and I think actually I should be selling here or I should be buying here. And as you saw on the last slide, we tend to make those decisions at the wrong time. So pretty confident that at this point in time, I should not be investing when actually markets are going up or about to turn, and confident that you should be buying when markets are euphoric at the top, when you have those emotions. So there's a couple of other cognitive biases that we have. So we have confirmation bias and anchoring. So confirmation bias is basically seeking out information that confirms your view. So ultimately, if you believe equity markets are going up, you're going to read the content, material, news articles which confirm that. And anything which is contrary to that, you dismiss it. So is that rational investment decision making? So is that taking in all the information to make your decision, or is that targeting specific information or having a specific bias? And then anchoring is looking back to previous events and thinking this event could happen again. So I think last year we saw a market selling off. So anytime we have any kind of a market wobble this year, the first thing people will think is this is last year all over again, when actually those events tend not to happen that frequently. So we just have to be aware of the various different biases that we might have, because that emotional investing can impact our ability to meet our long-term goals. So hopefully that's just provided you with a little bit of insight into some of the common biases that we display as investors. And from our perspective as investment specialists, it's our role to question biases that we may have as a team. So when we're selecting investments, we need to ensure that we're making evidence-based decisions, which are backed by numbers and data and logic, opposed to subjective decisions. The second area I was going to talk about today is fixed income. So I mentioned the fact that bonds performed poorly last year. And if we look at performance this year, bonds have delivered a positive return, but it hasn't been as positive as equities. So some people are probably disappointed. And the question for a lot of people is, what next for bonds? When will they start to deliver? So let's turn our attention to this slide here. There's two concepts which have been talked about in markets. One is called TINA. So TINA stands for there is no alternative. And this has been used to describe a world pre-COVID, as interest rates were so low that you could barely get any income at all from investing in bonds. And the US stock market is notorious for paying really low income or dividends. And what you can see here on the left-hand side is that this is a range of government bonds, and governments issue bonds for specific periods of time. So a 1-month government bond, 3 months, 6 months, 1 year, all the way up to 30 years. And pre-COVID, because interest rates were so low, you couldn't get an attractive level of interest or income from your bonds, because government bonds price off the central interest rate, or the central bank's interest rate. And what you could see is that you could get a more attractive level of income from equities, even though they don't pay a lot of income. So this phrase was coined, there is no alternative, TINA. So if you were looking for income, there was no alternative but to look to equities over fixed income, because you just couldn't get that income from bonds. So to me, the silver lining in obviously interest rates moving up is the fact that now you can get a higher level of income from bonds. And this shows you that that slide or that graph has changed dramatically because of the interest rate moves that we've had over the last year. So if I look at government bonds from 1 month, 3 month, all the way out to 30 years, the level of income I can get is much higher. And clearly it's higher than the level of income you can get from equities. So there are now reasonable alternatives. So this is the term TARA. So what this means is that people will now be looking at fixed income because there are now more opportunities there, or bonds. It's just another way of phrasing bonds, fixed income. This is an interesting chart because it just helps to put into perspective where interest rates are today. So if you look at interest rates, so this is the way we're looking at this, it's called the 10-year yield. So this is basically a 10-year US government bond and how much that US government bond has paid you in income every year. And it's looking back at that data over 150 years. So the point here is that there's a central range that it tends to trade in. So the normal range is considered to be 3 to 5%. And we've now moved back into that range. So for a lot of people thinking, is this normal where interest rates are today? Well, actually, when you look at history, the answer is yes. And you tend to find that perhaps you step outside of this range at certain points. And this usually is around specific events. So these events might be COVID, as an example. The 1970s oil crisis would be another example. The Great Depression would be another example. But I just wanted to highlight that, having higher interest rates, where they are today is not necessarily abnormal. This slide is a little bit more busy, but what we're trying to depict here is that actually today bonds are a lot more attractive than they have been in a long time. And we all know the reason why, because interest rates have gone up. But ultimately, once interest rates go up, we know that the next move tends to be down. So we do expect this move to be gradual. But what we're trying to see here is if we look at the columns on the bar, so if you look across here and here, you can see the 10-year US Treasury yield. So that's basically the income that you're getting from your government bonds. And it's saying if that income was 6% or 5.5% or 5% or 4.5, all the way down to 0, what does my return look like on fixed income as interest rates fall or rise from here? So at the moment, we're at about just 5.5%, call it. So if interest rates go up, bonds tend to sell off. But what we do know is that inflation is coming down, and central banks have signaled that they believe actually we're now closer to the end of this interest rate rising cycle. And the probability of a rate rise in the US now today is lower. And so what that means is that the likely move from central banks is to reduce interest rates. And why would they do that? So ultimately, when you raise interest rates, it increases the financing costs for people, my mortgage, and companies, business loans. And ultimately, that eats into your profit. And that drags on the economy. People are spending less, companies are spending less, and that leads to a contraction in economic growth. We're starting to see unemployment steadily pick back up. So you can see that the economy is slowing. And what will happen then is the central banks will say, well, inflation is down, it's coming down. If interest rates are 5.5% and inflation is 3%, and it continues to fall to 2%, they don't need to keep interest rates at 5.5%. They can start to reduce them, which will then help to relieve financing costs for individuals because my mortgage will be cheaper, and companies because business loans will be cheaper. And that cycle persists over time, raising interest rates, lowering interest rates. But what we're trying to depict here is the return you should expect to receive once those interest rates start to fall. And it's just interesting, obviously, to clearly highlight that you can see that the return increases and significantly as those interest rates continue to come down. So we do believe that we are now at the point of maximum pain. We've had all the interest rate rises, and the next move is obviously for interest rates to basically start to move down. So this is coined, the change in direction for bonds. This is a question which I think a lot of you are probably thinking about, or certainly a lot of individuals. Should I stay invested? Should I time the market, or should I hold cash? So what I did was, because I know that a lot of our decisions are emotionally charged, and that we display these emotional biases. And so a good example of this would be overconfidence, which might believe in our ability to think that actually I could time the market. So I wanted to ask the question, is there value in timing the market? Or, should I consider taking money out of the market and putting money into cash because it looks more attractive today? Should I herd into that asset class? And the way I tried to look at this is I asked one of the guys in the team, I said, can you run some data and can you look at various different benchmarks? Can you look at the S&P 500, so it's the top companies in the US? Can you look at the UK stock market, the European stock market? So what I've done is I've got the Euro stocks here because I know that W1, they're a global company, but they've got a presence in Europe. So I'm just using the Euro stocks to depict this, and I've got the returns in Euro. So we've run the data over 20 years up to literally the 7th of this month. So I said, okay, we're going back over 20 years. Now, what does the performance look like for that benchmark over a 20-year period? So every year, annualized, that just means every year on average, what has that benchmark delivered? And every year on average, if you were to stay invested over that period, the market has delivered 8.21%. Now, you might decide, actually, I'm overconfident. I think I can time the market. I know when to buy. I know when to sell. Now, the issue with that is that often the best days in stock markets are followed by the worst days. So normally you can get a really bad down day and then it can really reverse quite quickly. So you could get a 3-4% down day. 2 days later, the market can be up 3 to 4%. So often if you're trying to time the market because you're selling out after the market has fallen substantially, you then miss out on those big bounces. So if you're to miss the 10 best days in markets over those 20 years, it dramatically reduces that return. So that return goes from 8.21% annualized to 1.15. So it's quite a substantial difference. But the point is that as you continue to miss those days, it continues to impact your return. So from our perspective, we know that timing the market is incredibly difficult. We don't really know what can happen day in and day out because events which are outside of our control, geopolitics is a good example, is something that is very difficult to factor in. So the way that we protect against that is providing diversified portfolios with well-researched investments, because we do know that investing over time adds value. And so you'll often hear the term, it's time in the market, so staying invested, opposed to trying to time the market, which adds value over the long term. Now, what I wanted to do was to try to put this into monetary terms to bring it to life. So imagine we've got 4 different types of investors. And we've got one investor who thinks, I think I should be invested in cash. And we've got a second investor who suffers from herding, and they want to invest in the market, but they get the wrong call. They herd in and out at the wrong time. So in this scenario, what we have is those 4 individuals have £1,000 every single month to invest. And ultimately, then that equates to 12,000, and actually it's euros in this example. So it's 12,000 euros a year. So for the cash investor, at the beginning of every year, they just stick in their 12,000 euros. For the second investor who gets it wrong, they're herding, but they get their timing wrong. What they're doing is they're putting in their 12,000 euros into the market on the lowest point, or sorry, in the highest point for that day. They get it wrong. So the market's at its highest point for that year, they're investing. So the third investor suffers from overconfidence bias, but miraculously, they've godlike power and they manage to pick the day that the market is at its lowest point every single year to put that money in. And then lastly, the last investor, they take a logical approach. They confess, actually, I've got no investment edge. And ultimately, they just invest their 1,000 euros on the first day of the month every single month. So they call that averaging in. So we're going to call that in this case ECA, so euro averaging in, cost averaging basically. So I have a couple of observations from this. So after running these numbers. So firstly, investing in cash, it provides you with a positive return. However, it doesn't matter what type of investor you are in this scenario, you've still beaten cash. So the point is that, cash provides you with a level of comfort in a period of market stress, and it does offer you a higher level of returns at points in the cycle. So yes, I can get X amount in cash today, but that never persists for a very long period because those interest rates move up and down. And ultimately, markets are moving well in advance of various different news. So you're often missing out on quite good returns in markets. So from my perspective, again, I can see that cash will never enable me to meet my financial goals, particularly, those goals for retirement. So it's really not a long-term option. Secondly, I've kind of pointed out, it doesn't matter if you're a terrible investor. You get your timing wrong every single year. You pick the highest point to allocate your money into the market, you still get a superior return versus cash. And then thirdly, if you're really good at timing the market, it's obviously delivered the highest level of return. Now, interestingly, within this scenario, if you're just to forget all of that and average into the market because you accept, I have no edge, I don't really know what's going to drive markets on a day-to-day basis, but I do know that over the long term, I'm investing in companies and markets that are growing because of change in technology, and that will deliver growth for my portfolio in the long run, that actually your return isn't that worse off than spending a lot of time and energy trying to predict what's going to happen and ultimately putting yourself through an emotional roller coaster. So I just found that having looked through that is quite powerful. And again, I do a thing called a chart of the week, and I do send out charts. And this is an example of one I used last week. And I tell a little story when it comes to this, but I have an allotment. I don't know if anybody knows what that is, but basically it's a small patch of land which you can grow your own crops on, basically. So I was down at our allotment I live in a place called Kingston upon Thames, and just outside Kingston, there's an allotment. And I was down there and I was talking to one of the old guys on the allotments. And they've recently brought in this scheme in the UK called ULEZ, which is the ultra low emission scheme. So it just means if your car is dated before 2024, if you drive it on the road, you get charged a emissions tax. So it's £12.50 a day. So I was talking to Arthur down at the allotment, and Arthur is now 86. And ultimately, he was talking about the fact that he now has to change his car. And I kind of felt sorry for him because of his age and the hassle he has to go through, because he didn't want to spend £90 a week having to drive to the allotment. So the whole point here is that life can throw up unexpected events and expenses. And the other thing which this really struck me on this is that we are likely to live a lot longer than we anticipate. So the interesting statistic from this chart is that if you have a couple, one person from that couple, there's a 92% chance that they will live to 80 and a 51% chance that they live to 90. So you have to think that these are averages as well. And that if you're looking at the middle class and the upper class, you live a healthier lifestyle, you have access to better healthcare. So these numbers are even higher. So I'm coming back to that research that we did just about staying invested in the market, not trying to time the market, because ultimately, if you have long-term financial goals, you need to ensure that you achieve them, because that money that you're going to need in retirement really needs to last for a long time. And a lot of people aren't really aware of how long that could be. So my point is that it could be a lot longer than you anticipate. So again, it just really highlights the importance of trying to accumulate that wealth over time, and not to let emotionally charged decisions impact how you think. Okay, so I hope that's just given you a bit of insight. I've got about 8 minutes left before I sign off. And ultimately, what I'm going to do is talk a little bit about what next for markets. So a lot of people will be wondering, okay, we've had all these interest rate rises. That's going to lead to higher financing costs. What does that mean for the economy? So will we have a recession? And this has been a very talked about point in markets over the last year. So we pay for research from external providers to ensure that we've got the best access to information to help us to do our job. One example of that will be Goldman Sachs research. So we subscribe to their research. It's excellent. What this slide or graph shows you is the expectation for a recession. So this is Goldman Sachs expectation for a recession in the next 12 months in the US. And then consensus is all the other analysts from all the other banks, and they just take an average. So it could be Barclays Bank, etc. So what we can see here is that Goldman's have reduced their expectation for a recession in the next 12 months to 15%. The reason behind that is because they're saying, look, inflation is coming down. Unemployment is actually remaining quite resilient. Economic growth is okay. So we don't see any recession. And we like their research because generally they're pretty good. So, and their research is quite timely, so they update it quite a bit. You can see how it's moved around because they're taking into consideration information as it changes, and consensus can be a little bit slower. So why is that? Why do they believe that a recession is less likely? And there's a couple of things to highlight. So firstly, this chart here is nice in that a lot of people are concerned that companies will be faced with higher costs because interest rates have gone up. But what people are forgetting is that companies are run by quite savvy individuals. So if I'm a finance officer for a big S&P 500 company, what I was doing when interest rates were low is I was securing debt or loans at really low rates to ensure that I didn't need to take out any loans for a while because I secured those loans at cheap rates. And this shows you that about 46% of companies in the US don't have to renew their debt or their loans till after 2030. So the impact of higher interest rates is not going to hit them on the balance sheet for quite a long period of time. And that's why companies' earnings have been more resilient or better than expected. Secondly, I'm titling this stealth stimulus. So we know that central banks are basically taking money away. So they're raising interest rates. And they used to do a thing called quantitative easing, which was buying government bonds from banks and then giving banks cash so they could give it to us and lend it. So getting more money into the system. And what you're seeing is central banks are not doing that today. But instead of central banks trying to stimulate the economy, the governments have stepped in, and it's not really talked about enough. So this is just showing you a number of different, basically, acts that have been passed in the US to try and create economic growth or stimulus. So this thing here called the Inflation Reduction Act, basically they're spending billions every year to transition to green energy, to reduce our reliance on things like oil and gas so that we don't have to go through the episode we had last year where oil and gas prices caused big energy bills for individuals. And because of what's happening between Russia and Ukraine, a lot of countries around Europe are thinking exactly the same. So what you're going to see is accelerated spending on green energy. And what that does is it creates jobs and that creates growth. The CHIP Act is then producing microchips in the US instead of places like China, because again, concerned about trade and trade frictions and the reliance on other countries and then spending on infrastructure. But the big one is actually spending on defense. So spending on defense globally has gone up by 3.7% last year. It's likely to be more this year. Every piece of equipment that gets donated to Ukraine has to be replaced. It will be replaced with better and more improved kit that costs more money and actually more stock. And you're going to see a lot of countries, particularly around Europe, factor that into their budget. So I expect to see more stimulus, which again helps economic growth. And again, it's not really widely talked about. The other thing which we expect to happen, so I talked about fixed income and bonds, is they tend to perform better as interest rates begin to fall. And this is again some research from Goldman Sachs, and they're saying, look, this is where we predict interest rates get to. And so they're saying, look, you can see where we are today. They expect no interest rate rises from here, and then interest rates to fall. And you've also got consensus forecasts as well. So this, everybody else is thinking the same thing. So that's good for the bond side. So in terms of what next for bonds, we expect improved performance. What next for equities? We expect continued performance. In the US, the market has been what they say is narrowly led. So the US market is up quite handsomely this year. It's up about 17%. 66% of that return is down to 7 stocks. These 7 companies are world-leading companies that we engage with every day. Think of this medium that we're having this call. Think of your phone. Think of how you shop on Amazon. Global companies delivering good profits because they also have this new technology, artificial intelligence, which will help drive more growth and productivity going forward. And what happens is these companies are delivering growth over a long period of time. And you can see the market's expectation for interest rates coming down, which means that these companies will have a cheaper time to deliver those projects in the future while their share price are going up today. So people are thinking they've gone up a lot, what next? So it's our view that as interest rates begin to come down, it impacts the financing costs for all the other companies. Their financing costs get cheaper. So we expect to see broader participation. So other sectors starting to do well. So that's something to watch out for. So again, I just hope that's given you some insight into those key topics, how emotions can drive the way we think, how they can drive the way we think about possibly timing the market, the impact that obviously where we are today can have on the bond side of the portfolio. And our outlook today is, obviously a bit more positive than I think most people. And we've been right to have that view because we're trying to assess all of the information and make those rational decisions. So lastly, I just wanted to give you a quick flavor on the portfolios which we manage on your behalf. And this just shows you a snapshot of those portfolios. And when you have a lower risk portfolio, you'll tend to have less equity and more bonds. And when you have a higher risk portfolio, you'll tend to have more equity. And this is a drill down into what that looks like. So when you get a portfolio, you're getting exposure to multiple regions. So I would call it layers of diversification. So you're getting exposure firstly to different asset classes. So let's call it equity, bonds, cash. You're getting exposure to different regions like the US, the UK, Europe, Asia, emerging markets. You're getting exposure then to different companies in those regions. So there's multiple layers of diversification. So if something is happening in some region which is dragging down the portfolio, there's another element that's doing well. So it just helps to smooth out those returns over time. And then lastly, and importantly, it's performance, because ultimately, that's our job, is to deliver portfolios that can deliver performance. And this shows you performance of those portfolios since launch. And this is going back to 2019. And you can see the performance there over the Adventurous Fund is in blue. We've got the Balance Fund, which is in red, and we've got the Cautious Fund, which is in yellow. And so we're pretty pleased that we've delivered performance over this period, and you can see the annualized, so what we've been getting every year over that period. And to be fair, it has been a challenging environment. And we do look at the performance we deliver compared to a lot of our peers. And again, we're happy that we've been able to deliver superior performance to our peers. And ultimately, we believe that having a robust process and having attention to detail will enable us to deliver consistent performance over time. So that's something which we're trying to achieve. So I'm going to stop there for questions. I hope you found that insightful. So I'll just hand back to Carl at this point.
Thanks, Nathan. Very good presentation. Really like the slides on investing, and even bad timing is better than cash over the long term. Also, the slide on age of death. Someone who's 65, a couple, they've got a 92% chance of living until late. I thought it was really good. So thanks for that. We've had a few questions that have come in while you've been presenting. If anyone else has got any more questions, feel free to put them in the Q&A box and we'll try to answer them on the call. So first question, with the BRICS starting to trade in their own currencies, won't this put extra strain on the US dollar and affect their economy moving forwards? How to mitigate this risk?
Okay, so that's quite a good question. So there has been a lot of press about this, and ultimately, you're right, a number of emerging market countries are trying to basically trade outside of dollars. So a good example would be oil. When people tend to buy oil, they tend to buy it using US dollar, and now people are buying it using other currencies. So will this have an impact on the US? So I did see some research on this recently, and ultimately about 50% of all trade globally is in US dollar. And it's about 46%. That number has actually gone up recently. So there's a lot of concerns about economic growth in China because of the fact that property market is under a lot of pressure. You've got youth unemployment at 20%. Economic growth is slowing. Imports or exports basically to other countries are falling too, because they're losing ground to countries like Vietnam and South Korea. So what we expect to happen is it will happen gradually. And I've read a thought piece on this a while back, and they expect we get to a world where we're in 3 different states. So on one side, you have Asia. On the other side, you have Europe down through Africa, and then you have Americas down through South Africa. And ultimately, you get 3 different currency trading blocks. So you get US dollar, you get euro, and you get won. But that's not something which will happen quickly. And it's something which will be gradual. But I think in terms of technological edge, the US is still a long way clear of a lot of other countries. So we do think it's something that will happen over a very long sustained period.
Okay, yeah, that makes sense. Okay, next question. I've been offered structured products at 9% protected returns. Isn't this better than taking on market risk with uncertainty? So guess the question is, do those sort of products make sense at this sort of time? You mentioned about protected returns.
Okay.
But yeah, I guess that's structured products. I don't know.
Structured product.
Do you have those in your portfolio, Nathan?
No. So I suppose I have a couple of fundamental beliefs when it comes to investing. Firstly, if it is something that I don't understand, we don't invest in it. Secondly, I would really want to understand, is that product being offered by a regulated financial institution? Because ultimately you can have a lot of unregulated people. So they're not regulated by, say, the FCA, and they're promoting a financial product. So the problem there is that if anything happens with that product, you can't go and complain to anybody because they're not regulated by somebody. So you find that a lot of those structured products are not sold in the UK because it's a very heavily regulated environment. And ultimately, a product like that might guarantee you maybe a 9% return, but what happens to the money that you put in? So let's say I put in £100 and I'm expecting to get £9 a year for 2 years. What about my £100? Is that guaranteed? So you're guaranteed a 9% return, but nobody's saying I'm guaranteeing to give you back your £100. And in a lot of instances, a lot of investors have been left really hurt because they might end up getting back 80p, 70p, 60p, 50p, and there's no regulated structure behind it. So a lot of these products are essentially, I would say, missold, and they might be pitted as being backed by this big company or that big company, and they're not. So you want to do a lot of research, read the small print, check the fees. So if you don't understand it, don't invest in it, would be my advice. Okay. Actually, I'm not allowed to give advice, but yeah.
And we've got another question that's come in, which is, I've had this question quite a bit recently as well. With banks offering 4.5% one-year bonds, do you expect the balanced and cautious funds to outperform this in the coming months? So I guess the question is, why not move into fixed deposits rather than investing in a multi-asset? I guess that's
Yeah. So, and again, it just comes back to that research which we showed. So taking that long-term approach, if you invest in a fixed deposit, it's normally for a specific time frame. So your money's locked away. And ultimately, central banks could decide, actually, now's the time to lower interest rates. And you could see a really dynamic change in markets quite quickly. You can't capture that if you've invested in a product where you're then stuck. And that tends to happen, I would say, quite often because those products are now being offered after an event has happened, and they tend to gain a lot of popularity. But as you can see, we're most worried when we should be most optimistic. And that's the big challenge. And that really leads to investors missing out on those best days. So given the fact that we do expect interest rates to come down, we do expect to see improved performance from those lower risk products because they do have higher exposure to fixed income. So we're optimistic about that going forward. Yeah,
it makes sense. Yeah. Yeah, really good. I think there's good answers to those questions. Great. And that's it from us. Thanks for joining the W1 webinar. Hope you found it useful, and I'd like to say a big thank you to Nathan for all of his insights. If any of you have got any specific questions or you'd like to find out any more information, please get in touch with your advisor. We'll make sure that you receive a copy of the slides and the recording over the next few days. Have a great day, and thanks again for joining. And thanks, Nathan.
Thank you very much. Take care.